Hello, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you. Today's topic is how to deal with the market when we are encompassed with news events. So, let me go over two different types of news events, one that we can obviously prepare for, and one that we would not be able to prepare for. So, first off, there are certain news items that occur regularly and may or may not at a particular time actually really impact the market much at all. And then there are other ongoing and really more often than not have very little impact on the market. So, if you're concerned about economic reports, there are economic reports basically every day. And so you could go out there and find something to be afraid of if you desire to do so. Now, obviously, we don't want you to do that. Uh, the Bible does say over and over to fear not, do not be afraid. So we don't need to be afraid of any market conditions. In fact, depending on where you are educational level with us, you could have the money whether it goes up, down, or sideways. So there's no need to be afraid, and yet we can be cautious. So there's a difference between those two things. And sometimes, if our senses kind of perk up, that could actually be a good thing. It could be protecting us from something dangerous. So there are some people that take the approach, hey, there's a news item coming up. I know it's coming up. I know it's probably going to be a total event, but I don't know whether it's going to go up or down, it being the market. I don't know whether that news event is going to cause the market to go up or down. And so I am just going to sit here and wait it out. So that's one response, is just to sit on the sideline and go, look, there's a news item out there. I know it's going to sway the market. I don't know which way it's going to go. So I'm just going to sit it out and then try to respond later. So that's one response. The second response is to realize that more often than not, the market is going to respond a certain way and then leave open a door of opportunity to go the opposite way after that event occurs. So let's just say that you think that they're not going to pass, legislation to continue to raise the debt ceiling. So here's what I've found for 13 years of doing this. Very, very rarely will they actually shut down the government. It does happen, but very, very rare. Now, regardless of which side is in power at that time, they're going to talk big. The market's going to respond negatively, generally speaking, because they're like, we'll shut you down. We're not going to do it. We're not going to cave this time. All right. And they'll talk real big. And the market will drop. And then all of a sudden, they're going to be like, poof, made some concessions. All right, you guys give us more money to spend that we don't actually have, but let's just go print it and whatnot. All right. So then that thing is kind of over. And that's been the case for years and years and years now. All right. Well, again, it doesn't matter what side is in power. They're going to talk big about shutting it down. And then ultimately, because they can't figure out how to cut the budget, they just continue to raise it. So that's a news event that we see from time to time. You kind of have a consistency there to how that's going to work. Now, one of these days, maybe not. Maybe they actually are like, no, we're not going to do it. We're not going to keep spending more money. We're actually going to force you to lower the budget. But hasn't really been the case for quite some time now. So obviously the next big event is the Fed. All right. So this is another event that we know about. We know it's going to happen, and we know that it has had a significant impact on the market at particular times. This is one of those things where the timing matters more than almost anything else. So if the Fed is going to speak, and it is kind of the leading indicator at the time, and when they speak, it matters. And right now, because of the threat of them continuing to raise rates, and because inflation is still higher than they would like to see it, the thought of them raising rates still lingers. And then, of course, the market tends to dip whenever they do raise rates. And then eventually, historically, that leads to a slowdown in the market, eventually to recession. And then, of course, a bear market that would be in the midst of that recession, which normally is kind of an elongated recession. I actually have a chart of how that works, and may share that with you guys here in just a bit. But that is something that has been consistent as well. So again, it's an event we know it's happening. We know at times it has potential to really impact the market, but then there are going to be other times where the Fed is going to do what to do, but it's going to have minimal impact because nobody's really watching for that. They're not really anticipating them doing anything, or it's such a given that they're going to do this that what they actually do matters very little. So what I is, if you know the Fed is going to report, and a lot of times that report comes out on like a Wednesday afternoon, it's fine to trade Monday and Tuesday. What you'll normally find on Wednesday morning is there's going to be speculation what they think they're going to do, but Monday and Tuesday are going to be fairly normal days. So there's no need for you to sit out that entire week because the Fed is going to speak on Wednesday or maybe a Thursday. You can still trade early that week and things are going to be fine. Okay. So just kind of going with the flow, doing whatever is happening there. When it comes to particular news items about an individual company, it becomes less likely that you're actually going to know that's happening. So how do you treat an event that you were not expecting? Okay. Well, here's an event we do expect: earnings. So every quarter, every company has an earnings report. That's not unexpected, that's expected. And it is going to impact that stock. So they're going to have to come out and they're going to say, here's how much money we made. Here's how that compares to what we were expected to make. And here's our projection for the next quarter. Now, the combination of those three things could have an impact on what that particular company does and how the professionals respond to that report. So, was your profit basically in line with what we expected? Did you blow it away? Did you underachieve? They're going to take into consideration all of those things. They're going to say, okay, how did that compare to what we thought? Oh, wow, you were way better than we thought. That's interesting. Then they're also going to look at that and say, okay, so now that you've done better than expected, what are your projections for next quarter? I mean, is this an upward trajectory happening here? Or was this kind of something happened here, let's go assess it, see what happened, but we don't expect it to continue? Or do you think that, hey, next quarter is actually going to be worse, and maybe, because of the economy and different things that are happening, this thing could actually tail off, and so then it could actually drop even though they just beat expectations. So are you really trading off of, better than expected last quarter or potentially worse the next quarter? So that's why earnings reports become toss-ups, basically, coin flips, because there are three components there that they're going to consider. So obviously an earnings report every quarter, it's listed. You can find this in multiple places. That's going to come. That's a news event that is going to impact that particular stock at that particular time. Now, there are times when individual companies and earnings reports could be a driver of the market itself. And obviously you want to be aware. Let's just say you're trading Halliburton, but another company is reporting. Well, is your stock kind of the leading stock in that industry, or is it kind of one of the ones further down? Because sometimes if that leading stock comes out in your industry and they have a bad report, they may assume, okay, well, then the whole industry is going to get hit. So even though your company isn't reporting on that day, it could have an impact on your stock, because sometimes industries do move in collectively in cohesion with one another. So, beware of that. The other thing that might arise, and this happens from time to time, is an unexpected news event, guys. And thankfully, most of the time, you're going to be in a trade. You're not going to have an unexpected news event that really impacts you or the overall market. This happened a couple of months ago where our U.S. debt got downgraded. I don't know that anybody thought that was coming, but we were up near resistance. And then, of course, it fell drastically, at least for that particular day. In your own company, there may be news that they're going to be bought out. There may be news that they're going to buy somebody out. It's going to be a merger of some kind, and that could negatively impact your stock. There could be something that happens in that particular company that could be, them getting sued over something. It could be them just laying off people. It's just any number of things, but it doesn't mean that you would really know that. Okay. So if that were to be the case, guys, what you have to understand is that you're not going to know that information. Okay. And even if you did know that information and you acted on it, problematic too. So what if I knew that a company was doing and I acted on that information to the benefit of myself? Now, I know we can get into this debate, does Congress do that, et cetera? And the answer is yes. But we as individuals, right, would have to look at that and go, that's considered non-public information. Non-public information. If you have access to non-public information and you act on it to your benefit, that's called insider trading. Now that's problematic. So you go, Geoffrey, I've got this information. What am I supposed to do? Just sit on it, knowing that the market's going to fail or that my individual stock, my company is going to collapse? That's insider information. You're acting on insider information. So yes, it would not be a wise decision for you to act on that. So the reality is, guys, we can go out there and there's some particular types of strategies where you could basically just say, all right, I know there's going to be volatility. And if there's enough volatility up or down, there's a strategy out there where you could make money, whether it goes up or down. You'd be in two trades at one time, just kind of out there going, okay, I know it's going to move. I just don't know which direction. So you'd be planning on riding one, cutting the other. You could do that. There's some advanced stuff out there that allows you to do that. So you can trade even during volatility. Otherwise, you're sitting it out and then you're responding later. So you're going to have to make decisions, not a decision, multiple decisions, because they're just constantly news. And if you read our insider alerts, you're going to see that there's always news out there. And it may or may not have a significant impact on the market at that particular time or that week. But what I want to say to you guys is don't be afraid to trade because news exists. Oftentimes, the news will end up kind of making sense. When we go out here, and I'm going to share my screen here with you for a little bit. Let's just look at this and you say, okay, when I look at this, these news events have all occurred, right? So news events have been occurring all over the place. But when you look at the context of this chart, guys, I mean, look at our support and resistance lines and look at the S&P really staying within the confines, using moving averages, using the resistance line. Here's where we got that news about our debt being downgraded. And look at where it happens. Way up here at the top, that ends up creating what is now the lines for our downtrend. Look how consistent that resistance line has become. So just think about how many news items that have occurred over the last 2 months. And you go, man, I don't know. Can I act on that? Can I act on that or not? Here you are, hit support, it goes up. Here you are, it hits resistance, it goes down. Here you are, it hits support, and it's struggling to go up. And you think about all these things. It's under EMAs. It makes an M. So you've got all these news items, right, that could impact the market. And then more often than not, what you're going to find is I'm going to look back at the market, and that pattern is going to make sense. The timing is going to make sense. The movement is going to make sense. So my final word to you guys when it comes to trading volatile, newsy type markets is to realize, yes, sometimes the news will surprise you. Sometimes it'll go the opposite way. But more often than not, that'll end up making sense in the grand scheme of things. So don't be afraid to trade because a news item is coming up later this week. All right? Try to think ahead. Try to consider what the professionals are doing, what their thought process might be, and how you can imitate that and mimic that to get the results of what the professionals are going to do. Well, that is our tip for today. Hope you guys found that helpful. Appreciate you joining us each week, and we will see you next time.